All right, let's turn to page 34. We're going to jump ahead, and we're going to look now at 1 month U.S. Treasury bills. So we're no longer in stock land, we're in bond land. And in particular, we're in very short-term bonds. This is a 1 month bond issued by the U.S. Treasury from 1926 to 2021. All right. Now look, everybody, look at this. Look at this incredible investment. 1 month Treasury bills. There is not a speck of red, is there? Look at this. All the red that was up here in the Great Depression and here in the energy crisis and down here in the financial crisis. Would you all mind if I put all your money into this? Because it never loses money. Is that okay? Can we just end the lesson right now? And New Capital Management's going to go and we're going to trade all your accounts and we're going into 1 month U.S. Treasury bills. Actually, right now, pretty good yields on them. And we've bought a lot of them. But in general, what has the return been since 1926 on U.S. 1 month Treasury bills?
3.3.
3.3, thank you. And a dollar grew to be, here it is.
22.
22 bucks. Pretty good. A dollar grew to $22. Lisa, will 22 get you a martini anymore in New York City? No? Seriously?
Yeah, I would say more like last time I looked $45 or $50, maybe now.
No.
You know, a lot of places, yeah.
I'm not coming to visit you. You're going to have to come visit me.
Exactly.
$45 martinis on average?
I don't know if that's true because I don't really drink, but I remember going into a place, one of those places for drinks. I sat down, that was about 10 years ago, and it was $45 for a drink.
10 years ago?
Yeah, 10 years, maybe 15 years ago. $45.
So there it is, everybody. So you see the problem. Very little volatility in this investment, right? And it's never lost money, right? It's never had a negative year, but my goodness, it did 3.3% versus the S&P 10.5, US large cap 11.2, US small companies 12.1, and that wonderful collection of small Bank of Americas, also known as US small cap value, was it 13.4, right? All right. And again, why would this investment have a much lower return? Anybody? Okay, Rodney?
Low risk.
Yeah. Not just low risk.
No risk.
Yeah. In the world of finance, we regard this as having no risk. And when we say no risk, it's not quite true, is it? It's considered to have no risk of default. Although there are certain people in Congress who are trying to test that theory, as we speak. It's long been thought that the United States Treasury bond of whatever maturity you want to pick has no risk of default. But that doesn't mean it's not without risk, and we'll see that coming up here in a few more slides. Okay, let's go to the next page. The next page is long-term government bonds. So we're still looking at US Treasuries, but they're long-term, and long-term might be 20 years, could even be 30 years. I don't actually know what the duration on average is. Let's say this is 20 years. So this is, and you see we've got red again. Look, we've got some periods where longer-term Treasury bonds lost money, sometimes, several years in a row. And what was the return, anybody, on US long-term Treasury bonds between 1926 and 2021? Somebody tell me.
5.6.
5.6. Why would the return on longer term Treasuries be more over time than shorter term Treasuries? Anybody?
Compound interest,
Say it again, Robbie.
compound interest.
Compound interest, yes. It's true you got compound interest, but why would that interest be higher? What you say is true. Interest does compound, but why would the interest on average annually have been higher for a longer term government bond than a shorter term government bond? Yes, Robbie.
Accounting for inflation and some level of risk,
What risk?
because it's a longer term.
So why is that riskier?
I don't know. It's just something might happen in the longer term, and I'm not
Yeah.
not necessarily.
Well, I mean, you're right. You're lurking right around the answer.
Because they
Okay.
get to use the money longer,
Say it again, Catherine.
because they get to use the money for a longer period of time.
Yeah, you're close. The way you're saying it is they get to use the money for longer, but why is that riskier? Patty, go ahead. Why is that riskier?
Well, you don't have access.
You don't have access to the money, but why is that riskier? We talked
Because your
about
money's tied up. Yeah.
your money's tied
your
up,
mon-
but right
opportunity
now,
cost.
Berkshire shareholders, they've got their money tied up and they're happy to have it tied up. We talked about that. What? You guys are very close. Well, look at. If you come to me and say you'd like me to loan you money for 30 days, I'm going to say, okay, here's the interest rate for that. But if you come to me and say you want to borrow money from me for 30 years, it's going to be a different interest rate, isn't it? And it's going to be a higher interest rate. And it's not just that it's not per se that you've got the money tied up, or that it's that something can happen during that duration of time, right? Something could happen. You could go bankrupt. You could die. You could get fired from your job. You could become disabled. All kinds of things. There's all kinds of future path dependencies that could occur over that 30-year time period versus a 30-day time period. So yes, the money's tied up. That's correct. I don't have use of the money. That's correct. But at the heart of it is that something could happen. And so you got paid an extra 2.3% for that longer duration. This makes sense. Just like everything we talked about in stocks made sense. It makes sense that you would get paid over time more to own smaller companies, a collection of them. It makes sense that you would get paid more to own a collection of value stocks, Bank of America's versus Apple stocks. It makes sense. It has to make sense. Our entire economy runs on this. All of our corporations raise money based on this. Private ones and public ones. We have to have a logical system. It is not a casino. It has to be a logical system. And that system has to deliver logical results, and it has. both in stocks and bonds. Stocks are ownership in a company. Bonds are a loan. Because bonds are a loan, they tend to be less risky. Stockholders are entitled to a return if there are profits in a company. But if there are no profits, the stockholders get nothing. Bondholders have all sorts of legal agreements, including securitization against the assets of a company. And so they're less risky. And so they have yielded less. Let's go to the next page. Long-term corporate bonds are on the next page. What has the return been on long-term corporate bonds over the time frame? Anybody? Lower left?
6.1.
6.1%. Why did long-term corporate bonds provide a little over 0.5% more in returns than long-term government bonds?
Because they're more risky.
Why?
Because they're not secured by the faith of the US government. They're just people.
But even more specifically, they can't really print their own money, can they? Right? I mean, if it gets right down to it, the US government, while technically not true, it can't, technically just print money. It has to go through some things to do that. Powerful as Microsoft is and powerful as Google is, they cannot print money, at least not yet. Bitcoin is kind of an early attempt, really, although it's considered to be an open system. But they're riskier because and as Rodney said, they're not backed by the full faith and credit of the US government and therefore the people of the United States. They are purely supported by the profitability and the ingenuity of the people working at Microsoft. And that is a more fallible basis than the full faith and credit of the people of the United States of America, even as politically divided as we are. And so you got paid for that. You got paid to loan money to corporations over the long term, a little bit more than loaning to the US government, and $1 grew to $298. Lisa, could we get a martini and an entree with the 298 in New York, or not even any longer? Please tell me I could get a drink and an entree in New York City
For what?
for the 298.
Yes.
Okay, good.
Around the corner at the bodega.
The bodega,
I'm only kidding. Of course you can.
but not Tavern on the Green.
No, you could for that amount, 298. Yeah.
Okay. All righty, everybody. We're going to turn now. We're moving toward sort of conclusion territory, and we're going to jump ahead to page 50. Page 50, please, in your books, and I'm going to move it forward. And we're now on the inflation chart, U.S. Consumer Price Index. Interestingly, if you look at this chart, we've had only one outbreak of the opposite of inflation in U.S. history, which is deflation. When did that occur? You can see here from the little mini thing here, but if I go over to the data itself, look at that. Look at that. Look at that. During the Great Depression. Look at all that red. And we were lucky in 2008 to have as chairman of the Federal Reserve. Who remembers who was chairman of the Federal Reserve in 2008? Let's go to Sarah. Sarah, I saw your hand come up.
I believe it was Paul Volcker.
No, not Paul Volcker. Paul Volcker was the chairman of the Fed during the latter stages of Jimmy Carter's presidency and the early part of Ronald Reagan's presidency, and was well known for breaking the back of inflation by raising interest rates at that time. In 2008,
Was it
say it
Greenspan?
again?
Greenspan?
No, Greenspan was more in the 90s and I think early 2000s. Anybody? 2008. Who was chairman of the Federal Reserve?
How about Ben Bernanke?
Ben Bernanke. That's correct. Ben Bernanke was not just a central banker, but also was an still is, an economic historian. And he had done a lot of study into the Great Depression and the crash. And as is generally acknowledged, the Federal Reserve, which at that time was only about 13 years old, at the time that the stock market crash in October of 29 occurred in the ensuing Great Depression, the Federal Reserve, it's generally acknowledged what it should have done. What happens when an engine is starved of oxygen and fuel? What do? You give it oxygen and fuel, and money is the oxygen and fuel of an economy. And the general consensus among economic historians is that in 1929, when the Federal Reserve should have been stepping on the gas, they hit the brake. And Ben Bernanke had studied this. And so in 2008, the Federal Reserve did exactly that, which was step on the gas and give the economy gas. So we were lucky. So in 2008, if we go over there, you will see that we did not have a deflationary crisis. Here, I'm going over there. Here I go. There it is. So even in 2008, while inflation was 0.1%, it never went negative. And of course, we know that the Federal Reserve continued to provide astronomical amounts of liquidity in the years since then, and only last year began to pull it back, which is one of the reasons why we got what we got in 2022, much higher interest rates, lower asset values, but we needed to get that. We needed to return to normal interest rates. So what has inflation run on average since the 1920s? You know where to go. Bottom left. There it is. 2.9. And $1 in inflationary terms grew to be, there it is, $16. So that means that something that now costs $16, we know it's not a martini in Manhattan, that's way more. What costs $16 that we can generally agree on costs $16? I'm thinking like a movie ticket, or am I way off base? How about a movie ticket at like a normal theater, not one of these ritzy places where how about a normal like AMC, you go, you get your ticket. It's, it's just, wouldn't that be about $16 now, a movie? And so we could say that a movie back in 1926 would have cost about $1. Does that sound right? I wasn't around then. Anybody remember what movies cost around 1926? It was like $1, right? You'd go in and pay your $1 and see Charlie Chaplin. Didn't that sound right? That's inflation, and that's important as we turn to the next page. The next page I want you to turn to is page 52. And where are we? Well, what's wrong? They gave us the S&P 500 again. Did the printers make a mistake? So why have they given it to us a second time?
Inflation adjusted.
Inflation adjusted. That's right. Real returns. Look at that. So we're now going to look at, as we come full circle, is the S&P 500 after the effects of inflation are taken into account. And you can see, look at all the red here, much bigger outbreaks of red, those years where the return of the S&P 500 might have been positive, right? It might have been 5%. We might have had a 5% up year, or I'm sorry, excuse me. We might have had a 2% up year. But if inflation ran at 3% that year, then what was the real return of the S&P 500 that year? Minus 1%. And we had years like that. What was the return of the S&P 500 in real returns after inflation was taken into account since 1926 on average each year? There it is. Can everyone see it down there? 7.3. Now, that's a big difference from the 10.5, isn't it? That we looked at the first time. When we looked at total returns before inflation, when we started our lesson today. And look at the impact that that has on the growth of a dollar. When we first looked at a dollar in total return on the S&P 500, a dollar grew to $14,400. Look at the impact of inflation on an annual basis. Look what that did to your growth of a dollar. It really, really decapitated it. Even worse. So this is a big challenge in investing. This is the challenge that inflation poses to us, isn't it? Enormous challenge. Let's go to the next page, page 54 and 55, and buckle up for this one. We're looking at 1 month US Treasury bills again. 1 month Treasury bills after the effect of inflation is taken into account. Holy moly, look at the red. Look at it. Look at this, everybody. This is the investment that had not a single speck of red in total return terms. And I asked you, can I put all of your money into this? It's a fabulous investment. It never loses money. Right? That was back on page what? What page was that? That was back on page 34 of your matrix book. Look at page 34 of your matrix book and then flip it and look at page 54. The first is 1 month Treasury bills before inflation. The second is 1 month Treasury bills after inflation. And look at the bloody mess that went on year after year from 1933 until 1951. And how many people, how many Americans at that time, and 1 month Treasury bills is very close to cash. How many Americans do you think were so traumatized by the crash and the Great Depression that when their stockbroker came to them in 1930 and 1931 and said, I think you should buy stocks? How many people threw the stockbroker out on his head, because undoubtedly it was a he, and took their money and put it into coffee cans and buried it in the backyard? I'm guessing quite a lot. And what proceeded to happen to their money? Year after year sitting in the coffee can. So that by the time 1951 came around and they went out to the coffee can and they dug it up. Anybody ever see Breaking Bad? Remember Walt burying his money in the desert? They went out, they dug their coffee can up in 1951, and look, every year, 0.5%, 2.7%, 9% in 1941, the start of World War II. Their money went down 9% in real terms. 8% in 1942. 15% in 1946. If you held 1 month treasury bills, you lost 15% of the value of your money in the coffee can. In 1947, 7.7%. And so by 1951, if they had their money in 1 month secure US Treasury bills or in coffee cans and cash in the backyard, I dare say that half the value of the money was probably gone in real terms. All right. We're now going to wrap it up here, and then we'll do some questions. The same thing that goes for asset classes, and we've been looking at asset classes, also goes for portfolios. So if we turn to page 58 now, is that right? No, I'm sorry, page 64. What you have at the top of page 64 is this. This is a pyramid of a 100% bond portfolio. From 1985 to 2021. And so you can see we're not giving the same long sweep of time. It's a more truncated time period, but the principle still holds. And the return to this 100% bond portfolio was 5.1%. And $1 grew to $6.32. The chart below it, the pyramid below it, is now we add 20% stocks to what was a 100% bond portfolio. And now we have a 20% stock, 80% bond portfolio, and the return is now 6.9%. That makes sense. We added 20% riskier assets to the portfolio, and we got paid for it. We have some red. In 2008, that portfolio lost money, 7.8% of its value. And in 2018, it lost some too, but overall, you were up. $1 grew to $12. Our next page is 40% stocks and 60% bonds. We added another 20% in stocks, and 8.6% is the return. In 2008, that portfolio didn't lose just 7.8%, it lost 15.3% because you had more stocks. It's just the way it is. There's no free lunch. But $1 grew to $21 over the longer sweep of time. The next page is sorry, I'm struggling with the thing right here. The next page is 60% stocks and 40% bonds. That's page 66 at the top. A 10% return on that portfolio since 1985 through 2021. And again, in 2008, you lost 25% of your portfolio because you had a higher stock allocation. However, $1 grew to $34 over the entire period. You know what's next at the bottom of the page? We now go to 80% held in stocks and 20% in bonds. a 10.9% total return. And in 2008, that portfolio lost 33.6, 1/3 of its value. But over the whole time period, $1 grew to $47. And finally, all stocks on page 67, 11.6% return is the growth on average each year since 1985. In 2008, you lost 40% of your portfolio. But, booey. Sorry, it flipped over to the next page. But over the whole time period, where is it? Where's the growth of the dollar? There it is. A dollar grew to 59. So if we compare page 64, the all bond portfolio, 100% bonds, a dollar grew to $6.32, to the very last portfolio, 100% stocks, a dollar grew to $59, 5.1% return versus 11.6% return. And you can see that the line, the chart, the growth of the dollar is much more jagged on the 100% stock than it is on the 100% fixed income. It's a rougher ride, but you end up at a higher place. You see that the same principles that we've been talking about in the asset classes also apply in portfolios. So that is the last slide I want to look at. I want to turn to questions now. And what I'm trying to leave with everybody, if you take anything away from this, it is that it is a logical system. It makes sense. It's not a casino. It's not a magic act. I would not take your money and invest it into a system that was a magic act or a casino. Nor would I do that with my money. At New Capital Management, one of our clients is my family. And not only is one of our clients my family, but our largest client is my family. That's a very meaningful thing for you, because that means that not only do I have my family's money at risk, but a substantial amount of money is at risk based on these concepts. And these concepts are the best that we have and know in the world of investments, which is why I call it Investments 101. We have a system where people are compensated for taking risk, but we diversify to take those risks. We diversify to take your risks because any one Bank of America could go bankrupt. And Bank of America could have gone bankrupt. And so we don't hold your money all in Bank of America. It's spread out in a collection of Bank of Americas. And the betting is that they're not all going to go bankrupt. And that investors are going to be compensated for the stock market setting a price on that collection of Bank of Americas that is at a place where the returns are going to be higher. So let's take questions, if there are any.
Yeah, I have a question.
Okay, Lisa.
Okay. So I know so little about this, but I've heard over and over again from people that, at a certain age, you take no risk. That you only have a certain amount of years to live. But the way you're speaking, I'm saying it makes sense. It's like no risk. There's no such thing as a free lunch, as you said. My grandfather used to say that. He worked in the stock market. But it's like, it
He was
sounds like
wrong. There is a free lunch. There's one free lunch, and I'll talk about it in a second. No disrespect to your grandfather. He's generally right. But with regard to one thing, he's wrong. And I'll talk about that, but go on.
Yeah, so no, so I just want to know, so what do you have to say about age and being in the market versus what you just said? Like, it sounds smarter to take some risk. You got to take some risk.
This is sort of this idea that you take less risk when you get older is kind of a, I would say, well, no pun, it's an older construct. Let me give you two different, let me give you a profile of two different people. Let's take somebody who's 40 and has two small children and has $300,000 in savings and just lost their job, versus somebody who is 80, has $100 million, doesn't spend a lot, pretty frugal. Who would you say could take more risk at that point in time?
The older man with a
Yeah. And I give you that extreme example because what I think is everybody is different. And this is why we do financial planning with everybody, because that's really the gold standard of determining, where are you with regard to risk? Everybody is different. And so you have to put it all together. Age plays a role, but it is not in any way, in my view, any sort of definitive determinant of what someone can take for risk in a portfolio. There are a lot of variables. And I just gave you an extreme example. That person who's 40 and just lost their job, they may be headed, and if they can't find another job, and if they're going to be burning their savings, they may be all in bonds because they have to be. So it's an excellent question, but the acid test is everybody. What is your individual position, and that's what we make sure we take a look at. Thank you for the question. Anybody else?
There was a question that came in on chat. Are you investing our money in value with large and short value stocks?
Okay, I did want to show everybody that I meant to do that. So let me show you. Let me share the screen again, and let me show you some of the funds we hold for you and how they're composed. And thank you for that question, because that reminded me. So what we're looking at is a fund that we use. The ticker symbol is DFAC. It is managed by Dimensional, which you know about. And it is the US Core Equity 2 ETF. Dimensional, over the last couple of years, has launched a new batch of funds that are exchange traded funds. For a long time, the funds were open-end mutual funds. I don't want to get into the difference between open-end funds and ETFs, which are a form of closed-end funds today, because you guys have got to be close to overload right now. But what you see here is an analysis of this fund. This square right here, this grid is showing you value and growth, and in between is blend, which are not value or growth. They're right in the middle. Company might be like Coca-Cola. You might think of as a blend company. So Bank of America's, what's a growth company right now? I don't know, maybe some biotech company growing really fast. Moderna might be growth company. Coca-Cola, and actually, it's interesting. Meta was a value stock at the beginning of the year. It had fallen so far it had become a value stock. And then here you see size: large, medium, and small. So companies that are here are large, value companies, right? Small Bank of Americas would be right down here. Small Bank of Americas in 2008. And the blue circle shows you the extent of the investment profile that Dimensional operates for the US Core Equity 2 fund. And what it's showing you is that it tilts toward value and it tilts towards small. It includes growth stocks and it includes blend stocks too. So what you are getting when we invest you, and I myself am invested in DFAC, is an extraordinarily broad diversification that includes all manner of companies in the United States. This fund holds 3,000 different companies. It holds small value companies, Small Bank of Americas, and it holds medium-sized Bank of Americas, and it holds large Bank of Americas, right? And it holds big Modernas and small Modernas and medium-sized Modernas, and it holds large Coca-Colas and medium-sized Coca-Colas and small Coca-Colas, if you will. So why am I so comfortable investing such a large portion of your money into this and my own? Because look how broadly diversified it is within the fund. It's even more diversified than its Morningstar comparison category, which is the yellow. The fund is more diversified than the category that it's being compared to. The Morningstar US index that Morningstar maintains to try to measure exposure in the US market, the fund is more diversified than that. And what do they charge for this? Dimensional? Oh, well, you must think they must charge, 2%. Okay, maybe 1%. Nope. Maybe 0.5% is what they charge. They charge 15 basis points to give you this kind of extraordinary diversification. 0.15%. For you to own an investment fund from the most decorated and research-oriented asset manager in the world, 0.15%. It's an extraordinary deal. And I'll show you in just kind of in a different look, this. So this is taking that and turning it into weights. And so what you can see is that DFAC, this large cap United States fund, has 12% in large Bank of Americas and 21% in Coca-Colas and 21% in Modernas and 9% in medium Bank of Americas and 7% in small Bank of Americas and 13% in medium-sized Coca-Colas and 9% in small Coca-Colas and 6% in medium Modernas and 4% in big small Modernas. And when you add all this up and you say, well, how much of my portfolio's in small companies? Remember the small companies where the dollar grew to $47,000? In the lesson we just did, it's 18%. No, it's 20%. 20% of your portfolio is in small companies. Which is much more than is in the US stock market on its own, much more. And you can see, so the majority of your portfolio, let's call it maybe half of your portfolio, is in small and medium companies, which we would expect to give you a bigger return over the long term. And half is in big companies. Up here at the top, 21 plus 21 is 42, right? Plus 12 is 54. So 54% of the portfolio is in large companies and the remainder is in small and medium companies. And what is the US stock market in large companies? It's more like 90%. And we have you more like 54%, which over the long term, we expect to give you a bigger return. It may not, but over the long term, as I've showed you today, looking at the numbers, small companies and value companies and medium companies have delivered substantially higher returns over the long term. They've given you a premium. And this fund, I'm hoping, will give you a premium over the long term. Now, it's not only in the United States that we invest you. Here is another fund called DFAX. This fund invests outside of the United States. And I mean just about everywhere that is investable outside of the United States. Europe and Asia and South America. And look again, you see the very, very broad diversification that we are giving you. The blue circle is showing you that you hold large value companies and large growth companies and small ones. It's so broadly diversified that the Morningstar comparison category doesn't even come close. This fund, DFAX, which you might expect to see in the top 10 companies like LVMH, Moet Hennessy, which is now the chairman of it is the wealthiest man in the world now, Bernard Arnault. LVMH is probably number 5 in this fund. And you might see Siemens, and you might see Toyota, and you might see BP and Shell in this fund. But you will also see, as I pointed out in my year-end letter to clients, companies in Turkey. And I'm very sorry to say, everybody, that just a matter of weeks after I told everybody that the Turkish stock market was the best performing stock market in 2022.
Okay.
I am so sorry.
Still on
It's
this
a
call.
terrible tragedy that has happened in Turkey. And our hearts are with them. You hold 100 Turkish companies in this fund too. Best companies in Turkey. And I will show you that in this fund, here are the weights. There you go. 13% of this company fund is in small companies, right? And 31% are in medium-sized companies. You see roughly the same thing in DFAX. And so we combine DFAX plus DFAC, and you have exposure to the world, truly, for very little fee, enormous diversification. And so this is what we give to you. Other questions?
How do you decide on the small companies or and I'm guessing Fidelity or the other famous names of companies that they decided, and how do they decide on the small companies?
Great question. So Dimensional has trading operations all over the world and research people all over the world. And they are experts at analyzing what companies to include in their portfolios. And that's the answer. They have all sorts of criteria. The company has to be viable, and the company has to be qualified to go into their indexes. They have different screens. There have to be shares of a. Yeah.
So in terms of their track record, for instance, did they support Netflix? Like Netflix, when it started, was nothing, and then all of a sudden it's taken over the world, right?
Yes.
So do they?
Yes, and not, and a company may be small not only because it is starting out, but a company could be small because it was big and shrunk.
Hmm.
Okay, so you know, that can happen too, Lisa. You may have seen Bed Bath and Beyond is much shrunken in its value and is headed toward bankruptcy. I have no idea if Bed Bath and Beyond is in the portfolios, but it might be. So there are all kinds of reasons why companies are smaller than others, but what we can say is they're riskier. And so Dimensional is expert at trading, and smaller companies are harder to get the shares of. They don't trade as many shares. And so not only you can say, I want to buy a bunch of it, but you have to be able to trade it and get the shares without changing the price. And so all these things go into being able to trade it. And Dimensional began as a small company specialist back in the 1970s when it started. They started as a specialist trading smaller companies. So they have been doing it for a long, long time. They're experts at it. I can't do it, but they can do it. Other questions?
I think I do have a question. Can you hear me okay?
Yep, perfect.
Thank you. Thank you. So my question is not so much to do with how you're investing in terms of the returns of the different funds, because that seems, after this presentation, clear and convincing. My question is more in terms of like the advice for retirees or those contemplating retirement sometime, which is, tell me if I'm wrong, an approach basically that is advised here is that you're investing these funds, right? And then you're selling assets each year to at maybe like 4% draw rate to fund whatever needs you have, right? To cover living expenses. Is that a fair representation of the approach here?
4% is a famous number that was developed by a guy named William Bangen, who sort of is a retirement thinker and writer, and many years ago published work describing 4% as the sustainable withdrawal rate. There are all sorts of reconsiderations as to whether that is the number. The thing is that as financial planning software has gotten more sophisticated, and it has, then what somebody takes from a portfolio can be kind of more finely tuned, and everybody's different. As I was saying, everybody's different, and so but in general, I could say, yeah, 4% is a good sustainable rate. How we generate cash in a portfolio can be completely different for different people. It completely varies. If somebody has highly appreciated securities in a portfolio, it may not be so simple to just make a sale. And you may find yourself borrowing against that position. Interest rates are not nearly now what they were before, which were dirt cheap. Mm-hmm. And so how you achieve liquidity in a portfolio is always something that you have to look carefully at. So I don't think we have any one particular way to do it. And so liquidity could come from stocks, it could come from bonds, it could come from dividends, it could come from sales, it can come from a variety of ways. And so I think that's my answer. Everybody's different. Everybody has different liquidity needs, and how we meet liquidity needs is different. But that's a good thing. It's a good thing to have multiple tools at your disposal to generate liquidity. If you only have one, you can find yourself in a box. And so we're always looking for how can we do it, and timing is a question too. You know, when do you generate liquidity? If the market is down a lot, that may be a good time to generate liquidity. Because, for example, if the market's down and you have stuff that's highly appreciated, that might be a good time to do it. So there's no one size fits all, but it's a good question.
It's that I'm struggling a little bit in terms of different approaches here. Like when I look at the fund allocation, I think I'm coming at it from a little bit more of like a dividend perspective, right? And these funds actually generate very, very little in the way of dividends. And I think there's an alternative approach here that I'm really frankly just thinking through more deeply these days, which is if you have a fund or an allocation of different equities that you can generate 8 or 9% on, and then you're never touching the principal essentially, right? 8 or 9% a year. Maybe you're reinvesting 20, 25% as like your hedge against inflation.
But there's
Never
only
touching
one
the
measure. There's
principal.
only one measure, which is total wealth at the end. He who ends with the most money wins. That's the definition of investing success. And dividends are important, but dividends can be taxed. We've just been through a month where $130 billion in stock buybacks occurred. Companies took their own treasuries and purchased stock back, and that didn't cost shareholders any tax effects from receiving dividends. I'm not saying it's right or it's wrong. I know there's debate about stock buybacks, but a stock buyback that occurs, and if it's occurring when stock values are depressed, can be a backdoor dividend to shareholders. And $130 billion has just occurred through the month of January. And those were a form of dividends because they reduced the shares outstanding and increased the earnings per share available to shareholders. So what do we do about that? What do we say about that? If we're only investing for dividends and that's the and that's it, what do we say about companies that don't pay dividends, like a Berkshire Hathaway or an Apple for a long time, or bazillions of other companies? What do we do? Are they uninvestable? Is that, if that's the claim, the data shows that's not so. And so what the folks at Dimensional have done through regression analysis is to get to the reducted drivers of returns, and it ain't dividends. Sorry. If it was, they would have told us, because they're academics. They come from the University of Chicago. They come from MIT. They have a dedication to the truth. There is some correlation between dividends and value, because value stocks often may pay a dividend. But what do we say about those companies that don't pay a dividend? Are they uninvestable? The market says no, they're not uninvestable, not at all. And so do we leave them out of a diversified portfolio? And the folks at Dimensional say absolutely not. They're available for returns. The market may discount them if they don't pay a dividend, or may give them a premium if they don't pay a dividend. The market may say, we don't want that company paying a dividend. Their growth prospects are so off the charts that if they pay a dividend, we're actually going to whack their stock price, because they're going to have to go sell stock and raise capital and dilute existing shareholders. So that's all I'm saying. And I'm not saying that dividends aren't a good thing. The US stock market in general is yielding about a 2% dividend right now. International stocks yield substantially more, 3%, maybe moving up toward 4%. All I'm saying is that the evidence is not there that he who invests with higher dividends ends with more toys, with a bigger portfolio. There's no academic evidence of that.
Yeah, I think my only, and then I'm going to shut up because I know there's a lot of other questions, but I think what we're maximizing here, in my perspective, is not ending up with the most toys or the biggest portfolio at the end. It's actually the consistent coverage of living expenses, right? And I think that's kind of the dividend approach, is like making sure
but the markets are deep and liquid, extraordinary deep and liquid, and they have only gotten more deep and liquid. And so with the advent over the last 2 decades, two and a half, 3 decades of the internet, the tradability of securities is extraordinary, and now with ETFs, it's even more tradable. So we can turn securities to cash with the press of a button. And so if I say I'm only going to invest in dividends, then it's a problem in search. I'm sorry, it's a solution in search of a problem. But there is no problem gaining liquidity. Not even in our most stressed market periods have we had trouble raising liquidity. And bid-ask spreads are very tight. And so for me to say I'm only investing for dividends, like I think the best way is what I just said. It's a solution in search of a problem. There is no liquidity problem. There just isn't. And so if I do that, then I'm cutting my diversification dramatically, and losing exposure, and ironically increasing risk.
Okay.
And maybe getting all sorts of industry tilts because certain industries pay dividends and other ones don't. You know, so I've got no exposure to biotech. They don't pay dividends. Well, what are you going to do in a year when biotech is through the roof? Oops. So these are some of the potential risks and skews. And where we come to it on is we'd rather diversify and reduce risk. And we think because it's what's happened in the past, you're going to end up with higher total return. Anybody else? It's great questions, everybody.
Yes, speaking about the, I guess the amount of risk, is that from what you've said, it's just sort of a personal thing, Lynn? It's just, you know, what are you've given us the data. It's like, where do you personally fall in terms of your comfort, in terms of stocks versus bonds? It's not an age
Patty,
thing.
the volatility is a major focal point in our business with regard to risk. You'll get arguments. Warren Buffett himself will say volatility as a measure of risk is nonsense. Far be it from me to argue with Warren Buffett, who's one of my heroes, maybe my biggest hero in this world, and that I'm not alone in that. But we have to be able to say something about risk based on something, and we can't say something about something we can't measure, right? You know, so we have to be able to provide some measure of risk, and risk has come to be defined in our world as volatility. How much does something gyrate around? Because if something gyrates around a lot and you're retired, that is unnerving. And that can cause you to flee your investment. And so our job is to put you in a portfolio where the gyrations are tolerable. And it's really to get you right up toward a place where it might threaten to become intolerable, because generally that's where the maximum return is going to be. And so we have tools, we have questions. And one of the reasons we spend so much time trying to get to know you as people, and those early discussions we have with you and talking with you about you, is to get a feel for you know, what do you like and what can you tolerate? And so it's more of an art than a science. Scientifically, we can say what a 60-40 portfolio composed of these securities has as a standard deviation, and that's the metric, standard deviation. And what it means is 2/3 of the time, what return do we expect to see? Right? Excuse me, not 2/3, 68% of the time. That's one standard deviation under a normalized probability bell curve. Although finance academics are going to say that securities prices are not normally distributed in a bell curve. They have long tails. We get dramatic events, big booms and big busts, and so they will say that it might be normally distributed, but it's got long tails. But leaving that aside, let's just say that the returns of a portfolio are normally distributed. And so one standard deviation is what range of returns do we see either to the negative or positive side that falls between 68%, which is one standard deviation in a bell curve. So we know the numbers on that. Whether you can tolerate that is a completely different question. And that's where I, as an advisor, have to work with you and have some experience with you in order to put you in a place that is comfortable for you, but not completely gut the portfolio of return potential so that you're holding 1 month treasury bills, right? Which we saw the equivalent of a coffee can could seriously impair your long-term prospects. So your question is excellent, and I wish I had an I wish I had a firm, pat answer. We use questionnaires with you, we talk with you, we stay in touch with you, and we meet with you. And if you're ever uncomfortable in your portfolio, you know that we talk about that, pros and cons of making changes. I'll tell you this one story because it's a good one about the question you ask. Eugene Fama won the Nobel Prize in, can somebody look that up for me and jump in? F-A-M-A. Eugene Fama won the Nobel Prize. Eugene Fama is one of the founders of Dimensional. I think 2012, 2013. And Eugene Fama is known as the father of the efficient market hypothesis, which says that markets will incorporate all known information into prices, and that is true. We know that's true now. What year did he win the Nobel Prize?
I think 2013.
2013, Eugene Fama won the Nobel Prize in economics for his work in efficient market theory. And I was lucky enough, I've been lucky enough to have Eugene Fama speak to me twice. It's an amazing thing to get a lecture on statistics from a Nobel Prize winner. You pinch yourself. And I had it twice. And in that presentation, Eugene Fama was showing the statistical basis for the value premium. And laying out his math that they had done to make these incredible discoveries that they have over the years. And at the end of the presentation, somebody asked him, well, Professor Fama, how do you allocate your portfolio? You know, what percentage of stocks do you hold in your portfolio versus what percent of bonds? And everybody thought we were going to get, you know, this incredibly detailed statistical, mathematical proof of that question. And he smiled and he looked at us and he said, I don't know, 50-50. He said, that's what I do. In other words, even the father of modern finance and the efficient market theory, who knows mathematics, you know, at the highest level, enough to win a Nobel Prize, has not yet figured out a way to match a human being, including his own self, with a stock bond allocation in a portfolio. Even he cannot tell us what's the formula to do that. Isn't that an incredible story? So he just went 50-50. It's one of my favorite stories, you know, but it's what we really hard to do here at New Capital is to get you into that right comfortable place. Because Eugene Fama isn't giving me any math to do it with. And until he does, we have to get to know you as people. And that's what we do. Any other questions? Are we there? I hope this was okay. I hope it was helpful. Thank you all very, very much for your time today. We took a lot of it and went way over, and I'm sorry about that, but I really wanted to get through the material in at the right pace. And I wanted to involve everybody, because just me talking at everybody and giving away all the answers is not that helpful. And so I really am grateful and appreciative. And we really wanted to do this to make sure that everybody who has been our wonderful, loyal, and deeply appreciated clients for a long time got the same treatment as people who have joined us since 2016. And now everybody gets Investments 101. This was a lot of fun for me, and I want to thank everybody. And I really, really, really want to thank Catherine Barr. Catherine, thank you. Catherine, you know, we couldn't do these events without Catherine's help and preparation. And let me tell you, it's been weeks and weeks and weeks of sending people stuff and signing people up and sending reminders and getting the technology ready to go. And Catherine, thank you very much. You are the rock behind everything that we do here in these webinars. So thank you. All right, lunchtime for me. Thanks everybody.